Welcome to you, the listener, to a brand new deep dive on the Gap Advisors Ind AS Clinic podcast.
Thanks for having me back. We have a really fascinating structural puzzle today.
We really do. And,
Yeah.
before we even get into today's specific puzzle, let's lay out exactly what we are doing here, what our sources are, and, well, what the mission of this deep dive truly is.
Right. Getting the baseline set is always important.
Exactly. So we are looking at a highly complex structural reorganization within a corporate family today.
A very tangled family tree, to be honest.
It is. And whether you are a student pursuing your CA course, an auditor staring down like a seemingly impossible client meeting, or just someone who genuinely loves understanding the hidden mechanics of how modern businesses operate under the hood, this discussion is custom tailored for you.
Because our mission is to take a dense accounting query, completely strip away the overwhelming jargon, and extract the underlying logic.
Yeah, we want those aha moments. We want to move beyond just reciting the rules.
I mean, the goal is to uncover the philosophy behind those rules. Why did the accounting boards write them this way in the first place?
Right. What behavior are they trying to encourage, or perhaps more importantly, what loopholes are they actively trying to close?
And to do that, we're drawing from an incredibly robust source today.
We really are. This specific issue and the detailed analysis we're going to explore comes directly from the massive issue repository on gapadvisors.com.
Which is just a gold mine.
An absolute goldmine.
Yeah.
For those who might not be immersed in this daily, that platform hosts over 4,500 real-world issues. And it provides these highly detailed, actionable responses on both Ind AS and the older Indian GAAP standards.
That's a critical distinction, too. I mean, the older Indian GAAP was heavily focused on historical cost and strict legal form.
Yeah.
But the transition to Ind AS over the last decade really forced Indian companies to look at the economic substance of a transaction. And that often requires, complex fair value measurements.
Which is exactly what generates these massive tangled queries we love to untangle. And the practical value of that repository is just huge.
It really is.
Any person can register on gapadvisors.com for free. You can submit your own complex issues regarding Ind AS and Indian GAAP, and you get a detailed response delivered directly to the inbox of the email you registered with.
Which is a lifesaver.
An absolute lifesaver,
Yeah.
Especially for an auditor out in the field who needs concrete, authoritative documentation to justify exactly how they addressed a tricky application of Ind AS in their audit file.
Absolutely.
And today's specific conundrum was actually featured in the 233rd edition of the Gap Advisors Task Weekly newsletter.
Which is a great read, by the way.
It really is. That newsletter is authored by C.A. Manish C. Iyer, the director of Gap Advisors, and it's published regularly on LinkedIn.
With over 230 editions published to date, right?
Yes, over 230. It's basically a constantly evolving textbook of real-world brain teasers.
But before we pull apart the mechanics of today's specific transaction, we do have to establish a clear boundary.
Right, the disclaimer.
Exactly. The views expressed in this deep dive are the personal views of the author and are not binding on you, the listener. Every corporate scenario has its own unique, completely specific variables.
Which change everything.
They really do. So we ask that you always seek the help of an expert before taking any action or, refraining from any action based on the views we discussed today.
Because professional judgment in your specific granular context is just non-negotiable.
100%.
Okay, and finally, just to set our baseline rules for the universe we are operating in today. All the numbers, financials, and valuations we discuss are assumed to be in Indian rupees.
Right. Which serves as both our functional and presentation currency.
Exactly. Furthermore, our reporting period strictly runs from the 1st of April to the 31st of March.
And that timeline is not just background trivia.
No, it's really not. That timeline is going to be the engine that drives this entire conflict. So, let's unpack this.
Let's do it.
Usually when we talk about a medical diagnosis, there's an expectation of absolute precision. You break your arm, the x-ray shows the jagged white line, the doctor points and says, there it is.
Broken or not broken. It's a very comforting binary.
Right. We prefer our reality to be cleanly categorized like that.
But when you step into the world of complex corporate restructurings, that diagnostic machine completely breaks down.
It shatters. You can look at the exact same transaction, the exact same physical movement of assets, and depending entirely on where you are standing when you take the picture, the reality of what just happened changes completely.
It's a diagnostic landscape that is incredibly murky.
Murky, but highly structured if you know which lens to look through. So let's map out the corporate family tree we are examining today just to see exactly why the perspective shifts so drastically.
All right, let's build the tree.
Imagine a corporate hierarchy. At the very top, sitting offshore, we have the ultimate parent company. Let's call them ALTD.
Okay, ALTD. They are the overarching umbrella.
Exactly, the ultimate overseas holding company. Beneath them, incorporated right here in India, we have two sibling companies, CLTD and ELTD.
Got it. Sibling companies.
Now, their respective stages of accounting maturity are wildly different, which, sets the stage for our entire problem.
How so?
Well, CLTD is the older sibling. They have been preparing their accounts as per Ind AS for the last 3 years.
Ah, okay. So they are compliant, their systems are mature, they understand the rigorous demands of fair value accounting.
Exactly. ELTD, however, is a newborn. ELTD was literally just incorporated on the 1st of April 2018.
So they are a non-Ind AS compliant company.
Right. That dynamic is our chessboard. A multinational parent, a mature Indian subsidiary using Ind AS, and a brand new Indian subsidiary that is not using Ind AS.
Okay, the board is set. What's the inciting incident?
During the 2018-19 financial year, the older sibling, CLTD, decides it needs to spin off a piece of its operations.
A demerger.
Yes, a demerger. It wants to demerge one of its business units. Let's just call it Division C1. The strategic plan is for Division C1 to be moved over and merged entirely into the newly formed younger sibling, ELTD.
Okay, passing the division from the older sibling to the younger sibling.
Exactly. So CLTD files a formal court scheme in May of 2018 to initiate this transfer. And this is where the timeline immediately creates a trap for the auditors.
Timelines are always where the traps are.
Always. They file the intent in May 2018. The commercial appointed date for this transaction, the date the companies basically agree the transfer should be economically effective, is the 1st of October 2018.
Okay, October 1st.
But the bureaucracy grinds slowly. The scheme only becomes legally effective on the 1st of January 2019.
Which is the date the final order is stamped and filed with the ROC, the Registrar of Companies.
Right. You have just outlined the auditor's absolute nightmare.
We have intent in May, a commercial handshake in October, and cold, hard legal finality in January.
Yeah. And I'm glad we're looking at this because to a casual observer, the idea of a 3-month gap between saying we are doing this and it actually happening seems kind of absurd.
It does sound strange to an outsider.
Why does an appointed date versus an effective date even exist?
Well, it exists because commerce simply moves faster than the legal system.
That's fair.
I mean, in India, restructuring through a court scheme requires immense regulatory oversight. You aren't just moving a desk from one room to another.
Right, you're moving a whole division.
You are altering the underlying security of creditors, you're changing the tax footprint, shifting legal liabilities. The courts have to review the scheme to ensure, minority shareholders aren't being crushed.
Creditors have to be consulted.
Exactly. And the Registrar of Companies, which acts as the official government record keeper of corporate existence, they have to verify that all statutory requirements are met before they issue that final binding stamp.
And that simply takes months.
It takes months. So the appointed date, October 1st, in our scenario, is essentially the commercial line in the sand.
Like CLTD and ELTD are looking at each other and saying, look, we know the courts will take forever. Let's just agree that from an operational standpoint, the risks, the daily profits, the liabilities of Division C1 belong to ELTD starting October 1st.
Precisely. It is a vital mechanism to prevent a business from just stalling while lawyers argue in court.
That makes total sense.
From October 1st onward, ELTD is theoretically acting as the economic owner, but the legal system does not care about your commercial handshake.
Not at all.
Until the ROC files that paperwork on January 1st, CLTD still legally owns every single nut, bolt, and employment contract in Division C1.
It reminds me of a family passing down a vintage car.
Oh, I like that.
Right. So ALTD is the parent watching from overseas. The older sibling, CLTD, is handing the keys of this vintage car Division C1 to the newborn sibling, ELTD.
And they agree on a date.
Yeah, they say, as of October 1st, this car is yours. You pay for the fuel, the maintenance, the insurance. But the actual legal title transfer, the heavy paperwork they have to sign and mail to the motor vehicle department, doesn't get processed and officially logged until January 1st.
So in November and December, ELTD is driving the car, but if they get pulled over, CLTD's name is still on the registration.
Exactly. It's a highly functional analogy, I think.
It is, but we have to elevate that to an enterprise scale. I mean, think about it. In November, Division C1 might sign a massive new customer contract, or conversely, they might suffer a catastrophic equipment failure.
Oh, wow.
Economically, ELTD should reap that reward or bear that loss. But legally, CLTD is the entity on the hook.
Right.
It's incredibly satisfying when an accounting standard cleanly resolves a messy timeline like this, but finding the right standard is where most people stumble.
Which leads us directly into the meat of the problem. We're looking at this specifically from the perspective of CLTD's auditors,
Right, the auditors for the older sibling.
the ones who are giving the car away. And the very first query those auditors raise is this. Is the demerger of Division C1 into ELTD considered a business combinations of entities under common control, as per Ind AS 103?
It seems like a perfectly logical place to start, doesn't it?
I mean, yeah. When you see a massive division moving between two entities owned by the exact same parent company, your brain immediately screams common control.
Naturally.
And Ind AS 103 is the governing document for business combinations. So let's look at the actual text of Appendix C of Ind AS 103.
Let's do it.
It explicitly deals with common control. It defines it as a combination involving entities or businesses in which all the combining entities or businesses are ultimately controlled by the same party or parties both before and after the business combination, and that control is not transitory.
Okay, let's test our scenario against those exact words. Are the entities ultimately controlled by the same party before and after?
Yes, undeniably.
Yeah.
ALTD is the ultimate overseas holding company. They pull the strings of CLTD before the demerger, they pull the strings of ELTD before the demerger, and they still pull the strings of both after the paperwork clears.
Right.
From the parent's elevated vantage point, nothing has fundamentally changed. They just moved the furniture from the east wing of the house to the west wing.
And is that control transitory? I mean, are they just parking these assets temporarily to flip them to a third party?
No, there's no indication of that at all. ALTD intends to hold and operate these entities. So if we are strictly following Appendix C, it seems like we check every single box for a common control business combination.
It does seem that way.
So I have to play devil's advocate here. Why are we even debating this? Why wouldn't CLTD's auditors just apply Ind AS 103, calculate the numbers, and go home early?
You're touching on the mechanical aspect, but let's look at the foundational architecture of the standard. Standard setters demand a level of precision that goes far beyond just checking the common control box.
What do you mean?
Before you can have a common control business combination, you must first prove you have a business combination at all. And that requires us to examine Appendix A of Ind AS 103.
All right, looking at Appendix A, the text defines a business combination as a transaction or other event in which an acquirer obtains control of one or more businesses. Transactions, sometimes referred to as true mergers or mergers of equals, are also business combinations, as that term is used in this Ind AS.
Stop right there. The operative word in that entire paragraph is businesses.
Businesses.
An acquirer obtains control of one or more businesses. Ind AS is fanatical about defining what constitutes a business versus what constitutes a mere collection of assets.
So a business is more than just owning a building and some tools.
Much more. To meet the definition under the standard, you need an integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing a return. You need inputs like raw materials or intellectual property. You need substantive processes applied to those inputs, like a specialized manufacturing technique or a trained workforce.
Right, and outputs.
Exactly. You need the ability to create outputs, which are the goods or services that actually generate revenue.
I see where you're going with this. Let's say Division C1 was just a vacant warehouse and a fleet of rusted delivery trucks that CLTD hadn't used in 5 years.
Yes, a dead asset.
Right. If they transfer that deadweight over to ELTD, even though they are under the same common control of ALTD, it wouldn't qualify as a business combination.
Correct. It would merely be an asset acquisition. And the accounting boards deliberately drew this hard line to prevent companies from masking toxic asset dumps as strategic business combinations.
Ah, that makes sense.
If you buy a struggling warehouse, the rules for asset acquisitions force you to allocate the purchase price strictly based on the fair value of those specific physical items.
But if it's a real business,
If you acquire a living, breathing business, you invoke Ind AS 103, which brings in concepts like goodwill, contingent liabilities, and entirely different disclosure requirements.
Okay, that makes total sense. But let's assume for the integrity of our scenario that Division C1 is highly functional.
Let's assume that, yes.
It has a dedicated workforce, it has proprietary software, an active customer base, and it generates serious revenue. It is undeniably a fully operational business.
Agreed.
So we have a legitimate business being transferred, and it is happening between two companies permanently controlled by a LTD.
Yeah.
We seem to be right back where we started. Isn't this still an open and shut case for Ind AS 103?
This is exactly where the trap snaps shut on the unwary auditor.
Oh no.
It goes back to the medical X-ray analogy you opened with. While the control is undeniably common, the accounting standard does not view the transaction from some neutral, omniscient viewpoint in the sky.
It doesn't.
No. The text of Ind AS 103 is intensely biased toward one specific perspective. You have to remember whose books we are auditing right now.
We are auditing CLTD, the older sibling, the entity that is divesting or, giving the car away. They are the transferor.
Yes. And Ind AS 103 is utterly silent on how the transferor should behave.
Wait, what do you mean it's silent? An entire standard on business combinations just ignores the person selling the business.
Let's read paragraph 1 of Ind AS 103, which lays out the core objective.
Okay, reading it now.
It states that the standard aims to improve the relevance, reliability, and comparability of the information that a reporting entity provides about a business combination, but then it specifies exactly how it accomplishes that.
It says, this Ind AS establishes principles and requirements for how the acquirer recognizes and measures identifiable assets acquired, the liabilities assumed, and any non-controlling interest.
For how the acquirer recognizes and measures.
Wow. The acquirer.
Exactly. From paragraph 1 to the very last appendix, the standard is written exclusively from the perspective of the entity catching the ball.
That's crazy.
It dictates how the receiver brings new assets onto their balance sheet, how they calculate goodwill, how they handle the integration. The accounting boards did this intentionally.
Why?
Historically, standard setters were incredibly concerned with how acquiring companies might use the chaos of a merger to hide subsequent poor performance or inflate their balance sheets. So they built a fortress of rules around the acquirer.
So if you are ELTD, the younger sibling, you are the acquirer, you are catching this massive new division. For ELTD's auditors, Ind AS 103 is the absolute Bible.
Yes, they will open Appendix C, utilize the pooling of interests method, and follow those rules to the letter because they are the transferee.
But since we are auditing CLTD, who was throwing the ball, we literally can't use this rule book. You can't apply the rules of catching to the person doing the throwing.
You've hit the nail on the head. We often assume a major corporate transaction has a single, universal, objective reality. It does not.
It's all about perspective.
A transaction is a bridge between two sovereign entities. And the legal and accounting reality is completely different depending on which side of the bridge you are standing on. Because CLTD is the seller, they are not acquiring anything. Therefore, from their perspective, this is not a common control business combination.
What is it to them?
For CLTD, it is simply a transaction of sale under common control, a divestment.
A transaction of sale that completely shatters the initial assumption. The auditor's first query, is this a business combination under common control for CLTD? Gets a resounding, definitive no.
A very hard no.
Not because they lack common control, and not because it isn't a business, but entirely because they are standing on the wrong side of the transaction to use that specific standard.
Precisely. Which leaves our auditors standing on the edge of a cliff.
Yeah, what do they do now?
If Ind AS 103 just got thrown out the window, what safety net catches the seller's accounting? This naturally triggers the second major query from the audit team.
Which is, what is the actual accounting treatment in CLTD's books for the financial year 2018-19, and critically, what happens to their historical comparatives for the previous year, 2017-18?
Right.
Okay, so if we aren't using the combination rules, we have to look for the rules governing divestment. And that leads us straight to Ind AS 105, non-current assets held for sale in discontinued operations.
Correct. The moment CLTD's management commits to transferring Division C1, the clock starts ticking on Ind AS 105.
Okay, but let's look back at our messy timeline.
Let's review it.
The court scheme was drafted and filed in May 2018. The appointed commercial handshake date is October 1st, 2018. The effective legal date with the ROC is January 1st, 2019.
So when does the heavy machinery of Ind AS 105 actually engage on CLTD's balance sheet?
Based on the structural guidance, CLTD must apply the requirements of Ind AS 105 starting on the appointed date, the 1st of October 2018.
Yes, but, and this is a massive but that auditors must document rigorously, that is assuming all the strict, non-negotiable conditions for classification as held for sale under the standard are met on that exact date.
Ah.
You cannot just declare an asset held for sale because management had a good idea in a boardroom.
Let's dig into those conditions.
Yeah.
I imagine standard setters don't want companies arbitrarily moving underperforming assets into a held-for-sale bucket just to, like, clean up their main operational metrics.
That is exactly the manipulation the standard is designed to prevent. And AS 105 demands evidence.
What kind of evidence?
The asset or disposal group, in our case, the entirety of Division C1, must be available for immediate sale in its present condition.
Okay.
You can't say it's held for sale, but stipulate that you need 6 months to finish building the factory roof first. Furthermore, the sale must be highly probable.
And highly probable is one of those dangerous accounting terms that sounds subjective but is actually heavily defined, all right?
Very heavily defined. Management must be committed to a plan to sell, an active program to locate a buyer, or in this case, complete the internal transfer, must be initiated.
Right.
The asset must be actively marketed at a price that is reasonable in relation to its current fair value. And crucially, the transfer is expected to qualify for recognition as a completed sale within 1 year from the date of classification.
Well, given that CLTD had formally filed a binding court scheme back in May to separate this division, and the agreed-upon appointed date for that scheme to take economic effect was October 1st, it seems highly defensible for the auditor to agree that by October 1st, all these criteria were met.
I would agree.
The intent was locked in, the legal gears were grinding forward, and they fully expected the ROC to finalize it within a few months, well under the 1-year limit.
It is highly defensible, provided the documentation is pristine. So, assuming those criteria are met on October 1st, a seismic shift happens in CLTD's books. They must perform a massive reclassification. Every single asset, the manufacturing plants, the patents, the raw material inventory, and every single liability, the employee provident funds, the specific vendor payables associated with Division C1, are scooped out of their normal operational categories on the balance sheet.
They segregated.
Yes. They are moved to a distinct, highly visible section of the balance sheet under the heading Non-Current Assets Held for Sale.
So on October 1st, CLTD essentially builds a digital fence around Division C1. They put a giant neon for sale sign on it.
Exact.
But it's not just a change in presentation. Putting up that sign triggers a drastic change in how those assets are fundamentally measured.
It does. Let's talk about depreciation.
Okay.
Before October 1st, CLTD was diligently depreciating the machinery, amortizing the software, recognizing the wear and tear of daily operations. But the very second Ind AS 105 is applied on October 1st, all depreciation and amortization stops dead.
It just completely tops.
It ceases entirely. And this is where the philosophy of the standard really shines. Why do we depreciate assets?
Because they lose value over time as you use them.
Right. We depreciate an asset because we are systematically consuming its economic benefits by using it over its useful life. The cost is spread out to match the revenue it helps generate.
Makes sense.
But the moment you declare to the market that an asset is held for sale, you are changing your fundamental intent. You are telling the users of the financial statements, we no longer expect to recover the value of this asset through continuous use. We are going to recover its value in a single lump sum by selling it.
Oh, wow.
Because the recovery method has changed from use to sale, continuing to depreciate it would misrepresent economic reality.
That is a fascinating paradigm shift. The lens switches from operational use value to pure market sale value.
Precisely.
But wait, if they stop depreciating the assets in October, and let's assume the deal hypothetically falls through in February, aren't they artificially inflating their profits for those intervening months by avoiding depreciation expenses? Doesn't the standard worry about that?
Oh, the standard is deeply paranoid about that exact scenario.
I figured.
If the deal falls through and the assets fail to meet the held for sale criteria later, CLTD would be forced to immediately catch up on all that missed depreciation.
Ouch.
Yeah, they would have to retroactively adjust the carrying amounts as if the asset had never been classified as held for sale. The standard ensures you cannot temporarily park an asset just to avoid a few quarters of depreciation hits.
Okay, so the standard has a built-in boomerang effect to punish manipulation. I love that.
It's very smart.
So let's look at the actual valuation on October 1st.
Yeah.
The depreciation is frozen. How do they assign a rupee value to this fenced-off division?
Ind AS 105 mandates a very strict conservative measurement rule. On the date of classification, October 1st, the company must measure the disposal group at the lower of its carrying amount and its fair value, less costs to sell.
Okay, let's translate that. The carrying amount is simply the book value. It's what Division C1 is currently worth on CLTD's balance sheet right now. Historical cost minus the accumulated depreciation up to September 30th.
Correct. It is the historical internal reality.
And the fair value less cost to sell is the external market reality. It's what an independent, knowledgeable party would pay for the division today, minus the direct, unavoidable costs of actually executing the transfer-like specialized legal fees, stamp duties, or broker commissions.
Yes. You pit the internal book value against the external market reality, and the standard forces you to choose the lower number.
The lower number.
Let's explore the consequences of that. Imagine the carrying amount on the books is 100 million rupees. But due to some recent market shifts, the fair value less cost to sell is calculated at only 80 million rupees.
The rule is the lower of the two. So CLTD is forced to immediately write down the value of the division to 80 million rupees. They take an instant 20 million rupee hit to their profit and loss statement on October 1st.
Exactly. They recognize an immediate impairment loss. The standard is inherently conservative. It refuses to let a company boast a 100 million rupee asset on its balance sheet if management knows they're only going to realize 80 million when they actually finalize the divestment.
That makes a lot of sense.
Now, flip the scenario. What if the carrying amount is 100 million, but the fair value is a massive 150 million?
Again, the rule is the lower of the two. So you keep it frozen at 100 million. You don't get to recognize that 50 million rupee gain before the sale actually legally happens. You can't count your chickens before they hatch.
That is the essence of prudence in accounting. You recognize expected losses immediately, but you defer anticipated gains until they are realized legally.
Right.
So from October 1st until the legal paperwork finally clears, Division C1 is trapped in this fascinating holding pattern. It is frozen on the balance sheet, depreciating no further, locked in at the lower of its historical book value or its net market value.
I want to focus on the tension of this holding pattern because this 3-month gap, October, November, December, is where the real-world operational chaos happens.
It really is.
Structurally, commercially, CLTD is acting like they've already handed the division over to ELTD. The appointed date means ELTD is effectively taking the commercial risks. But legally, and on their own strictly audited balance sheet, CLTD is still holding on to this frozen block of assets.
It requires an agonizing level of meticulous record-keeping. During those 3 months, CLTD is still legally processing the payroll for those employees. They are still legally issuing invoices to those customers.
Wow.
But they're doing it almost in a fiduciary capacity as an operational custodian on behalf of ELTD, just waiting for the courts to tie the legal knot. Any profit generated by the division during those 3 months theoretically belongs to ELTD, but the cash might be flowing into CLTD's bank accounts. The intercompany reconciliation required here is monstrous.
And what if something catastrophic happens in November? What if a fire destroys half the factory while it is classified as held for sale? The fair value would plummet.
If the fair value drops below the already frozen carrying amount during the holding period, CLTD would have to recognize a further impairment loss immediately in November. The lower of rule is a continuous assessment, not just a one-time check on October 1st.
It's an absolute minefield.
Truly.
But eventually, we reach the climax of our timeline. The calendar turns. It is January 1st, 2019. The Registrar of Companies reviews the massive stack of paper, finds no objections, and stamps the final approval. The court scheme is officially, unequivocally, legally effective.
The big day.
What happens on CLTD's books on that very day? Taking down the for sale sign isn't enough. The house actually has to leave the property.
This brings us to the critical threshold of derecognition. On January 1st, 2019, CLTD must apply the derecognition requirements of the standards that govern the specific assets and liabilities making up Division C1.
Derecognition sounds incredibly formal. What is the actual mechanical reality of derecognition?
It means digital amputation.
Amputate.
Yes, it means systematically removing those specific assets and liabilities from CLTD's balance sheet entirely. CLTD no longer legally owns them. They no longer control the economic benefits flowing from them. The legal transfer of title is complete.
Right.
So the factory buildings, the specialized machinery, the trade receivables, the specific debt assigned to Division C1, it all gets erased from CLTD's general ledger.
So that roped-off frozen block of Non-current assets held for sale that we set up in October simply vanishes into the ether.
It vanishes from the balance sheet, yes, but accounting is built on the unbreakable law of double-entry bookkeeping. You cannot just make 100 million rupees worth of net assets vanish without a balancing entry.
It's true.
The difference between the carrying value of the assets you are surrendering and the fair value of the consideration you receive in return, whether that consideration is cold hard cash, newly issued shares in ELTD, or ELTD assuming a massive chunk of debt, that differential has to be accounted for.
And where does that differential land?
It drops straight to the bottom line. CLTD will recognize any resulting gain or loss on the disposal in the profit or loss section of their statement of profit and loss for that specific financial year, which ends on March 31st, 2019.
To put numbers to it, if CLTD handed over net assets with a frozen carrying value of 100 million rupees, and the court scheme was structured such that they received consideration, let's say ELTD shares, valued at 110 million rupees, CLTD books a formalized 10 million rupee gain on the exact day the ROC files the paperwork.
Exactly. The holding pattern ends, the transaction is finalized, the gain or loss is crystallized in reality, and CLTD's balance sheet is now permanently lighter, permanently reshaped by the divestment.
Okay, I feel like we have successfully navigated the turbulent, treacherous waters of the 2018-19 financial year.
We made it through.
We identified it as a sale, we classified it as held for sale in October, we stopped the depreciation, we survived the purgatory, and we de-recognized it in January. The logic is incredibly tight.
But there's more.
Yes, there's one final, massively important part to the auditor's second query. The auditor asks, will the comparatives for the previous year, the 2017-18 financial year, be restated?
The temptation of rewriting history. This is where the philosophical divide between the acquirer and the seller becomes a chasm.
And it's a huge issue for investors. Let's visualize the annual report CLTD is going to publish for the year ending March 31st, 2019.
Okay.
It is going to show a company that is significantly smaller. Division C1 is totally gone for the last quarter of the year. But when an analyst or a shareholder looks at an annual report, they never just look at the current year in isolation.
Never.
They always look at the current year side by side with the previous year to analyze the trend trajectory.
The comparative column is the lifeblood of financial analysis. It provides the context for growth or contraction.
Exactly. So when they put the 2017-18 numbers next to the 2018-19 numbers, it's going to look like CLTD's revenues fell off a cliff.
It will.
Not because the core business is failing, but simply because Division C1 was firing on all cylinders throughout 2017-18, but it vanishes from the books for the last 3 months of 2018-19. It's an apples to oranges comparison.
Right.
Does the auditor have to go back in time and strip Division C1 out of the 2017-18 numbers so that the trend line makes sense?
It is a deeply logical impulse, and the urge to create a clean, seamlessly comparable trend line is strong for any management team. However, the text of the accounting standard is unforgiving here.
What does it say?
The answer is a definitive, absolute no. The company shall not restate comparative information.
Let me push back on that because I want to make sure I fully grasp the paradox here.
Go for it.
Earlier, you mentioned that if we were auditing ELT, the younger sibling catching the ball, they would use Ind AS 103. And under the pooling of interest method in AS 103, ELTD does restate its historical comparatives. ELTD pretends that it always owned Division C1, pushing the history backward to show what the combined entity would have looked like in 2017.
That is correct. The acquirer in a common control transaction rewrites history to reflect the combination as if it had always existed under the parent's umbrella.
Wait a minute. This creates a massive glaring paradox.
I see where you're going.
If the buyer, ELTD, is retroactively restating their 2017 books to include the revenue of Division C1, but the seller, CLTD, is explicitly forbidden from erasing that same revenue from their 2017 books. Doesn't that mean if you look at the two sibling companies side by side, the exact same historical revenue is technically being double counted?
Yes, on a standalone basis, it is.
How on earth does the ultimate parent company, ALTD, consolidate that mess without inflating their global numbers?
That is a brilliant observation, and it highlights the genius of the consolidation process under Ind AS 110. You are absolutely right that at the standalone level, history looks slightly contradictory.
Slightly. It looks entirely contradictory.
ELTD is claiming the history, and CLTD refuses to surrender it. But remember, ALTD is the ultimate parent. When ALTD prepares its consolidated financial statements for the group, It must eliminate all intercompany transactions and balances.
Oh, the eliminations.
Exactly. The consolidation team at ALTD will see that ELTD has restated its 2017 numbers to include Division C1. They will also see that CLTD still has Division C1 in its 2017 numbers.
Right.
During the consolidation worksheet process, ALTD will make a top-level elimination entry to strip out the duplication. The ultimate consolidated history of the group remains perfectly accurate. The total group revenue for 2017 does not change by a single rupee.
That is amazing.
The standalone standards are designed to protect the integrity of the individual legal entities, while the consolidation standard cleans up the overlap at the very top.
That is genuinely fascinating. The standalone rules prioritize the strict legal reality of each separate entity, trusting the parent's consolidation process to act as the ultimate truth teller for the group.
Exactly. And let's explore why CLTD is forbidden from rewriting its history. Ind AS 105 operates on real-time empirical reality.
Okay.
In the 2017-18 financial year, CLTD genuinely owned, operated, and controlled Division C1. They hired those people, they bore the operational risk, they collected the cash.
That was the reality.
To go back and retroactively erase Division C1 from the 2017-18 financial statements would be to tell a fundamental lie to the shareholders about what CLTD actually was during that specific period of time.
It would be historical revisionism. It would distort the reality of the risks CLTD was taking in 2017.
Precisely. You do not rewrite factual history just because you made a strategic divestment a year later. Treating this strictly as a sale from CLTD's side protects the absolute historical integrity of their financial reporting.
But we still have the problem of the confused investor. If the comparatives aren't restated, how does the analyst reading the 2018-19 annual report understand the sudden drop in top-line revenue without panicking?
That is where the discontinued operations disclosure requirements of Ind AS 105 come to the rescue.
Discontinued operations.
While you are forbidden from changing the total bottom-line historical numbers of the previous year, what you are required to do is change the presentation of the income statement. You must clearly separate the results of Division C1 from the rest of the company.
You alter the presentation, but the underlying math remains identical.
Exactly. For the current 2018-19 financial year, CLTD will present its statement of profit and loss in two distinct halves.
Okay.
The top half will be continuing operations, the core parts of the business it is keeping. That will show revenue, expenses, and profit just for the retained business. Then, below that, there will be a single, highly visible line item for the profit or loss from discontinued operations.
And that's Division C1.
Yes, this single line will encapsulate all the post-tax profit of Division C1 up until the date of disposal on January 1st, plus the final gain or loss on the actual derecognition.
And how does that solve the 2017 problem?
Because the standard forces you to represent the 2017-18 income statement to identically match that new format. So the 2017-18 column will also be split into continuing operations and discontinued operations.
I see it now. So the investor can look at the continuing operations top half and see a perfect apples-to-apples comparison of the core business from 2017 to 2018.
Exactly.
They can clearly see the underlying growth trend without the noise of the sold division. But if they add the discontinued line back in, the total historical reality, the total net profit of the company for 2017 is perfectly preserved.
It provides absolute analytical clarity without committing a single act of historical revisionism. It is a highly elegant solution to a profoundly complex problem.
It really is.
And it highlights with terrifying clarity why the exact pathway you choose at the very beginning dictates every single subsequent step.
Let's trace that cascade of logic because it's incredibly satisfying when the pieces lock together like this. Because we accurately identify that we are the transferor, we realize we cannot use the combination rules of Ind AS 103. Because 103 is out, we must use the divestment rules of Ind AS 105. Because we use a 105, we classify the division as held for sale in October.
Correct.
Because it's held for sale, we immediately freeze depreciation and test for impairment against market value. And because it's a sale and not a pooling of interests, we execute a hard derecognition in January. And we absolutely, under no circumstances, rewrite the historical comparatives.
Perfect summary.
If an auditor gets that very first step wrong, if they assume common control means they must use 103, the entire audit file becomes a cascading disaster of errors.
If they mistakenly applied Ind AS 103 to CLTD, they would likely attempt to restate the 2017-18 financials.
Which is a huge no-no.
They would completely fail to recognize the held-for-sale purgatory phase in October, meaning they would improperly continue to depreciate assets that were designated for disposal.
Wow.
The resulting financial statements wouldn't just be slightly off, they would be fundamentally legally flawed, severely misrepresenting the reality of CLTD's operations to the market and regulators.
Which brings us right back to why the repository at gapadvisors.com is so vital for professionals in the trenches. It stops auditors from stepping on that initial fatal landmine.
It provides the map through the minefield. It replaces assumption with authoritative logic.
You know, as we wrap up this exploration, it is astounding to me how much philosophical weight is carried by the simple question, who are we auditing?
That really is the crux of the entire profession. I want to leave you, the listener, with a broader, perhaps provocative concept to ponder as you approach your next complex engagement.
I'm all ears.
Think about the pure physical reality of the events we just dissected. In the real world, Division C1 might not have moved a single inch.
Right. Physically, it's the same.
The massive stamping machines are still bolted to the exact same concrete factory floor. The employees are still badging into the same building, drinking from the same water cooler.
Yeah.
The ultimate boss, ALETD, sitting offshore, is still looking at the exact same consolidated profit numbers for the global empire. The physical universe has barely registered a ripple.
The physical reality is static, but the accounting reality is entirely fractured.
Yes. That single physically static event triggers vastly different, almost entirely contradictory realities based entirely on which company's letterhead is stamped on your audit file.
This is wild to think about.
If you are auditing ELTD, you are documenting a birth, you are recording an acquisition, an aggressive integration of assets, and you are actively rewriting historical records to pretend the new family has always been together. You are looking backwards to build a unified future.
And for CLTD.
But if you are auditing CLTD, you are documenting a separation. You are recording a disposal, a freezing of assets, the cessation of depreciation, and a hard, clean break from the past where history is fiercely protected and never altered.
Wow.
It challenges you to realize that in the world of advanced accounting standards, truth is entirely contextual. It forces you to always pause, look at the physical reality, and ask, whose shoes am I standing in, before you even think about opening the rule book.
Whose shoes am I standing in? That is an incredibly powerful diagnostic question. It takes us right back to the beginning. Corporate accounting isn't a simple medical x-ray where a broken bone is just a universally agreed upon broken bone.
Not at all.
It is a complex, multidimensional hologram. The shape it takes, the truth it reveals, depends entirely on your specific angle of approach.
And learning to deliberately navigate those angles, rather than just blindly memorizing rules, is what separates a competent accountant from a true master of the standards.
Wondrously said. I want to warmly thank you, the listener, for spending your valuable time diving deep into the fascinating, intricate, but ultimately deeply logical nuances of Ind AS with us today. It has been an absolute pleasure untangling this corporate knot with you.
It is always a joy to move beyond the compliance checklist and explore the profound philosophy behind the numbers.
Now, before we officially sign off, I have a few specific important favors to ask of you. If you found today's deep dive helpful, please take a moment to follow or subscribe to the Gap Advisors Ind AS Clinic podcasts. You can find us on Spotify, Amazon Music, and YouTube, whichever platform you prefer to listen to the Gap Advisors Ind AS Clinic podcasts on. We are there. Hit that subscribe button so you never miss an exploration.
And please do not keep this hard-won knowledge to yourself. The complexities of Ind AS application affect entire organizations, from the boardroom down to the data entry clerks.
Yes, exactly. We specifically request that you share this deep dive among your professional contacts. Send the link to your colleagues, drop it in your audit team's group chat, and share it with your broader finance teams.
Share it widely.
And I want to make a very special, targeted request. If you know any students who are currently pursuing their CA course, send it to them right now. They're often drowning in abstract theory. And this kind of practical, real-world application of Indian accounting standards is exactly what helps spread true, retentive knowledge.
It really is.
It bridges the gap between the textbook and the real world. And it might just provide the exact insight they need for their next exam or their first complex audit assignment.
The profession grows stronger when practical education is actively shared.
Absolutely. So remember our murky diagnostic x-ray from the beginning. The next time you encounter a corporate transaction that seems completely straightforward, a diagnosis that looks perfectly clean on the surface, force yourself to pause for a moment. Ask yourself if you are truly looking at the whole picture or just the localized reflection from the specific shoes you happen to be standing in. Until next time, keep diving deep.